Hello everybody and welcome to our Q3 2019 Investment Vodcast. We will start by discussing the performance of major asset classes over the quarter, followed by some of the macroeconomic events and data across the regions. This slide sets out the returns generated by a range of key asset classes over the third quarter. It was generally another positive quarter for most asset classes, however volatility remained heightened throughout the period. Bonds broadly outperformed risk assets as central banks around the world eased monetary policy. UK government bonds were some of the strongest performers over the quarter, benefiting from moderating economic growth and continued Brexit uncertainty, which have caused expectations of looser monetary policy to rise. Both European and US government bonds also performed well, as both the Federal Reserve and the European Central Bank loosened monetary policy in light of weaker economic growth and lower inflation. Corporate debt, both investment grade and high yield, also benefited from central bank easing. Despite expectations of weaker growth and the ongoing trade dispute between the US and China, developed market equities generated positive returns, although these were moderate compared to last quarter. Japanese equities were some of the strongest performers, reversing the losses that were experienced over the second quarter of this year. Meanwhile, Asia, excluding Japan, and emerging market equities continue to underperform. The ongoing trade dispute between the US and China and the escalation of violent protests in Hong Kong have increasingly concerned investors. Let's now move on to look at some of the noteworthy macroeconomic and political events over the quarter. Globally, growth has continued to slow, most notably in the UK and Europe. However, in contrast, unemployment once again fell across most regions. If we first look at the UK, GDP was confirmed to have contracted 0.2% over the second quarter. This was primarily due to declining industrial output and a slump in business investment, as the decisions of businesses to stockpile inventories ahead of the original 30th of March Brexit Day were reversed. Over Q3, PMI survey data suggested that the economy remained weak. In September, the UK All-Sector Output Index fell to its lowest level since July 2016. This would suggest the UK entered a technical recession in the third quarter. Despite this, the unemployment rate remained at multi-decade lows in September, while inflation declined below the Bank of England's target rate. Brexit, however, remains the principal concern for investors. Since becoming Prime Minister, Boris Johnson has adopted a hardline approach. He has stated that the UK will leave the EU with or without a deal on the 31st of October, dismissed 21 members of Parliament from the Conservative Party for not supporting his approach, and unlawfully prorogued Parliament, the full implications of which still remain to be seen. However, an energised opposition has pushed through a bill which will oblige the Prime Minister to request an extension of the Article 50 negotiating period from the EU should a deal not be reached ahead of the October 17th summit. As things stand, despite the strident rhetoric from the Prime Minister, it is still not certain that Brexit will occur on Halloween as planned. Moving across the US, whilst not as pronounced as in the UK or Europe, GDP growth has also weakened, declining to 0.5% over the second quarter. The ongoing trade dispute continues to have a negative impact on the economy, with exports plunging over the period. As a result of this increasingly soft GDP growth figure and inflation that remains below the Federal Reserve's target of 2%, the Federal Open Market Committee, the body charged with the operation of monetary policy in the United States, cut interest rates twice over the quarter. With jobs growth moderating and PMI survey data indicating a weaker third quarter, markets are expecting further interest rate cuts. Trade negotiations with the Chinese authorities are ongoing, despite an escalation in tensions. Tariffs have been raised by both the American and Chinese authorities, although further increases have been postponed for now. Furthermore, following approval by the World Trade Organization, the US has threatened to impose tariffs on $7.5 billion worth of European goods. This relates to the 15-year corporate dispute over EU subsidies to Airbus. In light of this decision, the EU has threatened to retaliate. Airbus's US rival Boeing has also received state funding. Meanwhile, in Europe, Eurozone economic data has continued to moderate over the quarter. GDP growth fell to 0.2% over Q2, with PMI survey data collated over the third quarter suggesting this may have weakened further. Germany is expected to enter a technical recession, its export and manufacturing heavy economy bearing the brunt of the ongoing global trade tensions. Inflation has also continued to fall. In light of this, the European Central Bank loosened monetary policy in September. The bank lowered the deposit rate further into negative territory and approved a new round of bond purchases at a monthly pace of €20 billion. These are to run for as long as it is necessary to raise inflation towards the target rate. In Italy, Matteo Salvini, the leader of the far-right League Party, withdrew support for the coalition government, anticipating that elections would be called. However, the Five Star Movement and the centre-left Democratic Party managed to put their differences aside and reach an agreement to form a new government, outmanoeuvring the former hardline Interior Minister. Italian bond yields declined significantly as investors were cheered by the creation of a more pro-EU government. Moving across to the emerging markets, most emerging market economies also moderated over the second quarter as the ongoing trade disputes increasingly impacted global growth. Chinese GDP slowed to its lowest level since 1992 amid weakening global demand, significant off-balance sheet borrowing by local governments, as well as the ongoing trade tensions. The People's Bank of China responded by cutting the reserve requirement ratio for banks, boosting lending to mostly small and medium enterprises. Meanwhile, the escalation of violent protests in Hong Kong have increasingly concerned investors. Looking forwards to the fourth quarter of this year, global growth is likely to remain subdued. Technical recessions are a possibility in both the UK and Germany, and potentially the wider Eurozone. Fiscal stimulus and looser monetary policy is to be expected across most regions. Despite the ongoing negotiations between the US and China, a trade agreement still seems far off. However, with an election next year and economic growth cooling, could President Trump be ready to blink? With regards to Brexit, although Boris Johnson has promised to leave the European Union on the 31st of October, do or die, the opposition-supported Benn Act obliges the Prime Minister to request an extension of the Article 50 negotiating period until the 31st of January next year, should a deal not be agreed. As such, it seems unlikely that the UK will leave the European Union this year. However, in light of the continued failure of Parliament to agree on a path forward, an election this year remains a distinct possibility. With that, I'm sure we can all agree that we are living in very unusual and uncertain times. I hope this has been a helpful overview of the macroeconomic backdrop and markets over Q3. I'd like to thank you all for listening and look forward to speaking to you next year in our first vodcast of 2020 in early January.